One of the reasons that people get frustrated using crypto tax software is because they have holes in their data. Recently, BitMEX, Bitmart, and Ascendex have announced that they're closing down. If you don't get your transaction records off of that, you'll have holes in your trading history. You can't prove what prices you bought things at. The online tools will end up reporting higher amounts of profit than really you need to report on your tax return. They're going to overstate the income and you're going to overpay your taxes because you have these holes in your data. You're not obliged to overpay your taxes just because you don't have the transaction records. If you have holes in your crypto data, which is very common, there are a couple ways to fix that. You might have proof of trading activity if you get those trade confirmation emails from your exchange. Basically recognize at a certain date and time you sold something, you bought something, and these would be proof points, even though you don't have the formal transaction histories out of an exchange. And we've done that before. We had one client who had done large transactions moving Bitcoin from an old exchange that had closed to his Coinbase account. And the IRS was challenging this at an IRS appeals level. And we did not have the transaction history records for that old exchange. But what we did have were the email confirmations that aligned to the record that Coinbase had of incoming Bitcoin transactions. So because he had these emails, he could say that those incoming Bitcoin transactions is not income to him, but rather a transfer of his own assets, which meant that they weren't taxable. So this is massive. We had to prove these things. And because we were able to do that, we were able to get that audit closed with having no change on his tax assessment. When you do your taxes, as your tax life becomes more complicated, even when we start to look at businesses, we don't always know the exact amount. We might know 9 of the 10 transactions that made up this number. We either forgot about the 10th transaction or we're not exactly sure if that transaction could be accounted within the time period. So what ultimately happens is once you reach the limit of what you can document from an accounting point of view, you reach a point where you need to make a reasonable, good faith estimate of what the correct number would be and pick a number that you can reasonably justify that that's what you think that particular income or expense item was. IRS calls this a reasonable good faith estimate. It's reasonable. You can have an explanation of why you picked it. It's good faith, that you weren't acting in bad faith, that you weren't being deceptive, that you're trying to do the best you could. We can deduce certain things. There's a particular court case known as the Cohan case, and it goes way back to the 1930s. It basically says that even though this particular person, Cohan, was an entertainer, traveled around the country, but he did not keep accurate records of his hotel stays and his restaurant bills, his travel costs. And the government said, "You don't have any receipts. We're not going to let you claim anything." And he went to court, and this is where we get the Cohan Rule, is that the court said, "Hey, look, yes, while he does not have this information, there is no way he lived in that particular state and ate at that venue without having some costs." Eventually, that's where you get some of the per diem thinking. And the per diem is used as a basis of indicating what your average nightly stay, average food balance, what bills would be for a day. There are ways to get around 100% accuracy if you don't have that information. And doing a good faith estimate costs you nothing. It's free and it's surprisingly accurate.